In 18.4, we're analyzing the impact of financial leverage. The problem we're given is KMT Stores is considering a renovation of its store. The project will cost $100,000. The company can issue 7% $5,000 bonds to finance 90% of the project. The remaining capital will come from internal sources. The renovation should enable the business to serve more customers. Complete the form to evaluate the effect of financial leverage on the proposed renovation. Evaluate the earnings potential from the project, assuming that operating income will increase by 6%, 7%, or 8% of the project cost. So here we have our 6, 7, and 8%. To get operating income, we're going to take the $100,000 that the project is going to cost times this percentage, and then we'll do the same across all 3 columns. So $100,000 times 6% is $6,000. For 7%, that will be $7,000, and then $8,000. To find our interest expense, it's on those bonds that we're going to be giving out. They're 7% $5,000 bonds. So when we take the cost of this project is $100,000, 90% will be financed with the bonds, that's $90,000, times the 7% interest of the bonds, that's going to give us $6,300 that we have to pay back each year. So now what we're going to do is we're going to subtract these. So if we're only going to get $6,000 under our 6% scenario, if we have to pay back $6,300, we are now losing $300. Under the 7% scenario, we are gaining $700, and under the 8% scenario, $1,700. We now have to find the federal income tax on this amount. So 25% of $300 is the negative 75. 25% of 700 is 175, and 25% of 1,700 is 425. What we have to do now is subtract these. So 300 minus a negative 75, we're actually adding it. We are now down to a negative 225. 700 minus 175 is 525, and 1,700 minus 425 is 1,275. So now our investment is going to be the $10,000 because the total cost is $100,000. We're financing 90%, which means we're coming up with 10% of that on our own, or $10,000. And that's the same across all 3 columns. So now they're asking us for the return on our investment. So you take the net income, so a negative 225 divided by $10,000, and we get a negative 2.3%. 525 divided by 10,000, that's going to be a 5.25% or return on our investment. 1275 divided by 10,000 is going to be 12.8%. So now that we have all of this data, we're now being asked in number 2, under what conditions should KMT Stores renovate the store? So that if we're looking at this, obviously it's not going to be at the 6% because we're losing money. So only at 7% or greater, we should go ahead with this project. So we'll say only if they can increase operating income by 7% or more.